Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett Fu, it's almost the end of the month, almost the end of the quarter, and stocks are being interesting.
Stocks are being interesting. They did end the 5-day losing streak, at least for now.
At least for now. So on that note, let's get to the biggest stories right now in the $22 trillion global ETF industry. As we were just talking about, you're seeing stocks rise a little bit here after last week's big tech sell-off with the S&P 500 set to snap that 5-day losing streak. We'll see, of course, if this picture holds into the close.
All right. Plus, we're going to speak with Giang of Securitize on how tokenization is becoming more of a reality on Wall Street and the role that she's playing in doing that.
And we dig a little bit deeper into a fund that's investing in the World Cup frenzy, and it also owns Comcast. We're going to discuss the plan to have another spin-off. All of that and more coming up. But as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now, and he's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you very much. Good to be back. The flows are interesting this week. A lot of stuff you have to just ignore because every quarter or so they have these rebalances and you see money coming in and out as a way to sort of like minimize capital gains. And you can see IVV 48 billion. That's not real. Okay, so this is tax-oriented. This is not. The Q's taking in 4 billion legit, which is interesting because SpaceX will be in the Q's, I think, next week. So people coming in ahead of that, which is interesting. You know, this is obviously the big news the past couple of weeks. DRAM also. This is insane. This ETF came out of nowhere. Theme ETFs normally don't punch in this area, 3 billion in a week. It's also now taken in like 18 billion since launching only a couple months ago. It's in the top 10 year to date, which is hard to do for a new launch, especially a theme. This thing holds 3 memory stocks. That's it. Brilliant idea from Roundhill. ALVL, that's an Avantis large cap value. This thing is also 16 billion. They grow up so fast. I was shocked to see that, but it's taking in a ton of money. Avantis, I think, recently crossed 50 billion in assets. Let's look at the outflows, and you're going to see, again, a lot of big numbers. VU, negative 52 billion. Of course, that would never happen. VU is always on the leaderboard, so ignore that. Same with these. Anything with a V right now, just forget it because it's tax-oriented. Cows, though, interesting. This is the Cash Cow ETF. Had a huge success, some money coming out, although it still has well over 10 billion in it. But let's talk about the big story of the past 2 weeks, which was the SpaceX IPO. We've been tracked. We like races. I like races. So we've had a race for the 2X SpaceX ETF. 11 of them launched. This was a lot. They all launched on the same day. So who's going to win this derby? Well, the early leader is SPCH, leverage shares, which is interesting. They are big in Europe. They don't have a really big hit products here. Most of the leverage stuff is like ProShares, Direction, Defiance. But they somehow got the flows and the volume. They are way ahead in the lead here. $500 million is big, but look at the volume. It's traded 6.5 billion in the 2 weeks since it's been out. IBIT previously held the record for the most volume in 2 weeks at 3 billion. So this is now the ETF with the most volume in the first 2 weeks by double any other ETF. That is how much of a frenzy we've seen around the SpaceX ETF and these ETFs trying to give you double exposure, Katie.
All right, Eric, thank you. And joining our conversation now, I'm pleased to say, is Nancy Tengler. She is CEO and CIO of Laffer Tengler. Nancy, great to have you with us. So I guess we should start on SpaceX. You know, I know that you don't own Tesla specifically in your ETF. That is TGLR as the ticker there. But when you think about the style investing that you do, you know, high conviction, I know you take a lot of looks at these old economy companies that are sort of incorporating the new economy. Where does a Tesla fit in, or rather a SpaceX fit into your calculus, especially when you think about the ripple effects that it's having around the public markets right now?
Yeah, Katie, good to see you and good to be with you. We own SpaceX in our growth strategy and in our thematic strategy, which is space, robotics, quantum, and nuclear. And we have been accumulating it on weakness. We were in the first day, got a decent average cost, and then we've been adding to it. What we're looking for, particularly in the thematic portfolio, are narratives more than and fundamentals, but much more focus on that than valuation that are going to change. These are companies that are going to change the way we live in the next 3 to 5 to 10 years. So that's important to us. In TGLR, we do the same thing. We just require a growing dividend. And that tells us management's conviction about the future. So 2 years ago, we added Google, not a high absolute yield, but convicted dividend growth. And then recently we added NVIDIA. and we've continued to add to it.
If you're looking for a company with a growing dividend, I mean, doesn't that knock out a lot of tech companies that want to plow that cash back into their investments, especially now as they build out their AI capabilities? It could be a long time, if ever, a company like SpaceX issues a dividend and grows it.
Yeah, no, you're absolutely right, Scarlett, that this is a core holding strategy. And then we decorate around it in our client portfolios. But this is a strategy that where we focus on dividend growth as an indication of what management sees in the future. But if you look at our top 10 holdings, and I'm just going to look at them because like sometimes I can't remember. If you look, it's Lam Research, that's the top holding. Broadcom, we own Google in the top 10. So there are Microsoft's in there, which has been better in the past, not so great lately. But that is what we try to focus on. They're fallen angel growth stocks where the dividend is important, but we're not buying these names for the absolute yield. So we also own Apple, we own Cisco in the portfolio in technology, and we're almost at a market weight in technology. I mentioned we added NVIDIA recently. We want companies that are growing the dividend because they're confident about the future.
Nancy, let's talk about your AI theme. And you're not alone. A lot of people are into this. There's an ETF called Chat. Roundhill has it. It's up 100% in the past year. Now, in contrast, the software ETF, IGV, is down 18%. This is an interesting dispersion here because they're really mostly part of the same sector. You rarely see that. What's the case to go more into AI? It seems like, well, okay, this has had its run, but IGV is full of these really, dynamic companies, Microsoft being one of them, that actually owns a lot of OpenAI. Why wouldn't we want to play a rebound in IGV versus buying more AI?
I think you probably should. Now, not all software is created equally. So we got out of CRM a number of years ago, Adobe a number of years ago. Most of the names that we've stuck with, some of the cyber software, some consumer software like Spotify, some of those names many of those names have outperformed the market. But then there are names like ServiceNow, which has not. And so the question we keep asking ourselves is, are we wrong? And I think Microsoft will recover. Google is a software company to a great extent. So is Amazon. But there are different nuances. And so I think if you're comfortable being in the ETF and sort of passively investing in the group, I think the good names will carry you. But if you want to be stock specific, and that is what we do the research, we talk to management, we listen to the earnings calls, and we constantly reassess our thesis.
Well, you're touching on what I was wondering about, and that is, what your sort of average turnover or holding period looks like, when it relates to your different portfolios, including your ETF TGLR. I mean, how long do you tend to hold a name versus, maybe it's time to cut our losses and rotate out of this?
Yeah, that's a great question too, Katie. We are long-term investors, obviously. Our average holding period in TGLR is between 20 and 25. I'm sorry, the average turnover between 20 and 25%. Average holding period kind of 3 to 5 to 7 years. We've owned Apple in TGLR and in our value portfolios. We've owned it since 2014. So yeah, we've trimmed around the edges, but we were early in and we're still in. So in our growth strategy, it's similar, 30 to max 35%. And our thematic portfolio is, and our 12 best ideas, obviously lower turnover because we're high conviction in those portfolios.
Nancy, one of the big questions for this market is how much longer it's going to continue, right? It's up, the S&P, about 8.4% so far this year, and it's already had 3 straight years of double-digit returns. I know AI keeps giving it new life, but some people wonder whether we're kind of late in the tooth here for equities overall. How do you look at the longevity of this bull market?
Yeah, I mean, that is the question, Scarlett. I think we're not late innings, actually. In the 90s, when I was managing money, we saw earnings growth of about 60% from 95 to 99, but stocks were up 220. over the previous 5 years today, we've seen earnings growth 70 to 80%, 75 to 80%, and returns of about 80 to 85%. So markets multiples are not expanding dramatically as they were in the 90s. You had John Chambers come out and say, this technology is much more powerful than the internet and cloud computing combined. John Doerr of Kleiner Perkins said, this technology is underhyped. AI, that is. So I'm not hanging my hat on that, but I am also not building portfolios only around AI. Even though robotics is physical AI, we do think that space and quantum are going to play a role, and we think energy sources are changing, and that's why we're focused on nuclear as well as SpaceX as a possible solution. So I think what is different this time is it's not just eyeballs on a screen like it was in the 90s. That's how we measured companies, eyeballs on a web page. Now it's a much more robust collection of technologies, and that's where we're focused as a firm.
All right, Nancy, got to leave it there. Always great to start the week with you. That is Nancy Tengler of Laffer Tengler. Now, coming up, we speak to Chris Marangi of Gabelli Funds on how to invest in the World Cup fever next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start where else than memory stocks. DRAM, as Eric was talking about at the top of the show, fastest ETF in history to $10 billion in assets. Take a look at it now. Those assets stand at $24 billion. Having a rough day in today's trade, falling more than 2%, but that's basically flat for some of the moves we've seen in this fund. But I also want to point out a new launch, and that is DRAL. It is a 2x version ETF from Defiance. That fund began trading last Thursday. Let's also talk a little bit about single stock ETFs, because they now account for more than $50 billion when it comes to the U.S. They do come with an extremely high price tag compared to other ETFs, maybe those more vanilla index tracking funds. But as a result, these funds generate $550 million per year in revenue. That is according to Bloomberg Intelligence. Let's end, of course, Scarlett, with the FTSE Russell adding SpaceX to its flagship U.S. and global benchmarks, including the Russell 1000 today. And that is just the appetizer, because in about a week or so, stock will join the NASDAQ 100. And all told, those index additions are set to spur buying worth at least $5.4 billion from index tracking funds. Another fun stat brought to us courtesy of Bloomberg Intelligence, Scarlett.
All right, of course, by Bloomberg Intelligence. That the data just continues to provide context for us. All right, another event that has taken off in June is the World Cup. According to a report from Gabelli, FIFA is projecting $11 to $13 billion in total revenue for this Cup's commercial cycle. That includes broadcasting, sponsors, merchandise, and ticketing. So it's a huge ecosystem. Chris Marangi is co-CIO of Value and president of Gabelli Funds. And of course, the firm has a GOLS ETF, which holds publicly traded soccer clubs. And he joins us now. Chris, talk to us about the rationale, the explanation for owning soccer clubs. I look at the return on the fund, the performance so far this year, and it's trailing the S&P 500. So a lot of times people say they want to own sports because it provides an uncorrelated performance with the broader market. But in this case, it's trailing the S&P 500.
Yeah, well, that's right. I mean, we're not looking. We're looking to maximize long-term performance. I do think that sports assets are unto themselves. Over time, actually, they have compounded at a rate greater than the S&P 500 in the mid-teens over the last 10 years. And there are many reasons that wealthy people buy sports teams. Some of it's ego, but they are great stores of value. They're inflation indexed. They are somewhat economically resilient, and we think AI resilient.
Let me ask you a question. This is just, if we're looking at these soccer clubs, and I have a friend who's really into it, but generally speaking, I think the reason America is so into the World Cup is because it's easy to understand, right? It's got all the countries, all the best players, and the stakes are really high. But when you think about regular soccer and all these different leagues, it's just not that easy to get into. The players are dispersed. Do you need soccer to be sold to America more, like the way the World Cup is, for some of these clubs to make more money, or is that not necessary? They can do very well even without like the casual fan like me.
Well, I think the hope and the belief is that this World Cup taking place in among the richest markets in the world in North America will drive interest more globally in the sport. And there are actually 35 or so publicly traded sports assets, teams and leagues. Most of them are soccer clubs that trade very lightly in Europe. And this is a very efficient way to access those clubs. And those clubs have traded in the private market at about half the multiple of most U.S. teams. And they're going to need money. You look at some of the pitches in Europe. They're very old. They don't maximize attendance. And so we think those clubs are going to need to raise capital here in the U.S. to fund that construction. And so you'll see some uplistings and some increase in valuations in that respect. But yeah, and listen, it's the biggest sport in the world. The World Cup final will draw probably 10 times what the Super Bowl has drawn. So it's a big deal, and we think it's at least a moderate catalyst for this fund.
All right. I want to ask you about one of the holdings in GOLS, GOLS, and that is Comcast. Of course, Comcast, a distributor of a lot of the World Cup games through Telemundo, but also just involved in the sports ecosystem. The company came out with news today that it is going to split up its businesses and basically spin off the broadcast side along with Telemundo and the theme parks, and then, of course, keep its broadband operations separate. What does that mean for how you position Comcast within your portfolio?
Yeah, so when I started here at Gabelli almost 24 years ago, I started as a media analyst. And so I've been covering this company for a very long time. Comcast acquisition of NBC in 2009 was seen as a great deal. Still think in retrospect it was a very good deal. They paid a great price to GE for it. But the world has changed. And so not a huge surprise that they're separating the broadband assets from the content assets. We own into the fund because NBC is part of the sports ecosystem, both because of their rights to the NFL and other sports, and of course because of their rights to the Olympics. So that's why you own it here. As far as the deal goes itself, we do think it will be value surfacing for this company, which trades at a very cheap multiple all by itself. And this should increase the strategic possibilities for both sides of the house. Don't think anything happens immediately on the content side, but do expect further consolidation amongst broadband companies.
Well, Chris, I am curious. I mean, taking a look at the statement from the company, Comcast shareholders will have shares in both businesses. And, you know, I know it's early days, but do you plan to hang on to shares of both companies, or is there one that you would, prioritize over the other?
Well, speaking more broadly, of course, across all of our funds, we'll have to look at where the valuation goes. But specifically with regard to GOLS, we do want to see some true alignment with sports assets, sports interests. So, broadband doesn't fit quite as well. But we do own a number of companies in the broader sports ecosystem, including venues, ticketing companies, and media partners. So that would fit well here.
All right, good stuff. Chris, thank you so much for joining us. Chris Marangi of Gabelli Funds joining us from Rye, New York. Still ahead on ETF IQ, we look at a market-neutral ETF that's designed to help reduce equity risk and volatility through the Bloomberg Intelligence traffic light system. This is ETF IQ. It's time now to take a look at the Bloomberg Intelligence traffic light system, which ranks ETFs by risk levels. So green light means low risk, yellow light means moderate risk, and red light means high risk. Eric, what do you have for us today?
Today is a very unique ETF, AGF US Market Neutral Anti-Beta Fund.
That's a handful.
Yeah, I know. The ticker is BTAL. That's what we call it. It's been around for a long time, about 15 years. This is an ETF. Like, I know the market's very long in the tooth and people are like, oh my God, maybe I should get a short position. This is a true alternative. Now it gets a yellow light because it is actively managed and it has hidden fees. It goes long low beta stocks and short high beta stocks. So in a situation where you think these really high memory stocks or AI stocks is going to get sold off really hardcore, this should go up But it won't be that dangerous if that doesn't happen because you already have a short position in low beta stocks. I mean, a long position. So it's really a true market neutral. But if you do think the AI bubble is going to burst, but it won't bring down the entire stock market, this should have a good run. It was up 20% in 2022. So it's sort of like a kinder, gentler way to hedge or short the market than one of these leverage ETFs.
Less than 30 seconds here. You mentioned hidden fees. I take a look at the expense ratio, 1.4%.
Wow.
What categorizes as a hidden fee here?
In the case where you're shorting stocks, you have to pay to borrow. So the borrow costs of those end up in the expense ratio. If you did this on your own, you'd have to pay for it. The management fee is going to be a fraction of that, though. So they're only taking a little. The rest of the cost is the borrow cost to short these stocks. But really, honestly, this is pretty revered by some of the more professional investors out there. They look at it as a kind of a true hedge fund that you can use that isn't that, it doesn't have the volatility drag that negative leverage ETFs have.
Right, and not at hedge fund prices either, as a result. All right, thank you so much, Eric. And of course, besides the traffic light, a reminder you can listen to Eric and Joel Weber on Trillions, their podcast that covers the industry. This is Bloomberg ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric, what do you got?
Today, Katie, we have an ETF that has a ticker with the same letter 3 times, FFF. It's the Founders 100 ETF. This is one of the more simple things I can explain, which is that it looks through stocks, mostly large cap, and says, okay, which stocks that the person who founded it is still running the company, right? Makes sense. That's the visionary founder who was successful. Wouldn't you want to invest in that? That's the idea here. It's not big at 5 million, right? So it's just new, but it's, I don't know, 6 months old. 75 bips is the fee, which is about average for a thematic ETF like this. Let's look at the holdings. And you will recognize some founder-led companies at the top here. Meta, NVIDIA, Dell, Oracle. But you don't get, like, for example, Amazon, Jeff Bezos left, or Apple, Steve Jobs left, Tim Cook took over. So this is exactly what you get. You can see there's 100 holdings in it, hence the Founders 100. Now let's look at the performance. And again, 6 months isn't a lot to judge it, but it has struggled out of the gate compared to the S&P. Now there's a lot of software and AI stuff we're probably going to discuss when it comes to this. But that right there, 15%, that is a big gap, but it's early. We'll see what happens. With 100 companies, it can move quickly one way or the other. And if it does have a rebound, I think it'll get some looks, Katie.
All right, Eric, thank you. And joining us to talk about this ETF, I'm pleased to say, is Michael Monaghan, who manages this fund. Michael, first off, great to have you on set with us. And let's talk a little bit about portfolio construction here, because as Eric mentioned, you have about 100 companies in your portfolio. I see that Meta is at the top, though. That's about 6.3% of your portfolio, and then it cascades from there. So how do you think about weighting here when you're putting this together?
Thanks for the question, Katie, and thanks for having us. So we run a modified market cap weighting. So we start with a market cap weighting, and we constrain any one position at 7% to manage risk. We did a bunch of scenario analysis prior to starting the fund, looked at weights from 3 to 10%, and found that the best risk reward over very long periods of time, looking at this data set, would be with a 7% cap.
Okay, 7% cap, SpaceX going public,
Yes.
led by Elon Musk. How did you incorporate SpaceX into the fund?
So the one place that we have discretion, it's generally a factor model, picking the stocks. The one place we have discretion is on founder IPOs that meet the mandate, and we bought a 1% position on the IPO.
It seems like if I'm looking at why it underperformed, Apple, Amazon, it looks like Microsoft, looks like there's some companies in there where they're part of the Mag 7 but not founder run. And so what do you attribute that to? Like when you see a company where the new person took over and they have a lot of success, does it challenge the thesis here?
So if you look at the Mag 7, it's actually the Mag 3. The strong performance in the Mag 7 has come from Meta, Tesla, and NVIDIA. So I think it holds. And the same thing applies to the NASDAQ 100 and the S&P 500. So the strength in the NASDAQ 100 has come from the 20 founder-led companies, and the 37 founder-led companies in the S&P 500 were driving the outperformance.
And just to zoom out a little bit, I mean, it's interesting. It's an interesting concept. And, you know, as Eric said, It makes sense, but tell us why this needs to exist. Why this launched 6 months ago? What was your sort of guiding idea and vision when you did come up with this?
Yeah, so the guiding vision was actually a spark of inspiration. I was at the Smithsonian and saw the Fort McHenry flag, and it maybe ties into the U.S.'s 250th anniversary. We looked at the flag and got inspired and said, look, the people that built America are different. These are iconoclasts. My partner, Lauren Cassidy, has been running money for 20 years. And I said to her, what would happen if we built a portfolio of only iconoclasts? And founders are iconoclasts. We looked at 11,000 stocks over 30 years, and the average outperformance by a founder CEO versus a board-hired CEO was 4%. We saw that it didn't exist. We saw that the S&P and the NASDAQ are both dramatically underweight founders. They're about 30% founders. And we wanted to bring this high efficacy form of investing to our customers and the people that are investing with us.
What you have in the end is a company or an ETF that's very heavily tilted to technology. Different forms of technology. You've got software, you've got internet media, you've got semiconductors, tech hardware, but I believe in total you've got 51% weighting in technology. So it almost feels like a version of the NASDAQ 100.
So I think there's some key differences. The first one being the founder factor. The second one being we've got a bit more tilt to software versus semis. The NASDAQ has had a great benefit this year from the run-up in memory stocks. As we know, those are deep cyclicals, and deep cyclicals at one point will reverse. And so we think there's quite a bit of differentiation between the two products.
You know, you're not the first, right? You're what we call an ETF on the Lazarus list. You resurrected an idea that had come out previously. BOSS was the ticker.
Yep.
Global X had the fund. It looks like it closed in 2023. You come along. Not that that can't work. The airline ETF was the third one and actually had success. What makes yours different, and why do you think you can make it work where they failed?
Yeah, so I think the first thing we noticed, we looked at BOSS, we looked at a couple others. All of the rest of them modeled themselves as something called founder-like. And so they put founder in the name, but they weren't actually focused on only owning founder-led stocks. We believe we're the first to do that, to own the founder-led stocks and to jump all the way into the deep end of the pool and commit to it.
All right, Michael, that's a good place to leave it. Really appreciate you stopping by. That is Michael Monaghan of Founders ETFs. And you can read all about this drill down, plus the latest in the ETF industry when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. But coming up on ETF IQ, the show, the tokenization takeover. Why more exchanges are opening up to the new trading tech. Giang joins us in her new role. She's now the VP and head of issuer growth over at Securitize. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Scarlett Fu. Let's get to the ETF life cycle, where we walk you through the three main stages of ETFs, from initial filings to final farewells. Step one is the filing, and the SEC is now reviewing paperwork for the Defiance S&P Accelerator ETF. So ticker SPA will be an actively managed fund investing in the S&P 500 or S&P 500 ETFs. But the twist is it will offer additional exposure to recently listed companies that are not yet a part of the benchmark index, presumably like a SpaceX. Step two is the launch. State Street's new NASDAQ 100 ETF began trading under the ticker QNDX. With this debut, State Street now offers ETFs tracking all the major U.S.-focused equity benchmarks. QNDX charges 10 basis points a year, making it cheaper than the biggest NASDAQ 100 fund, Invesco's QQQ, with its 18 basis point fee, as well as the 15 basis points charged by QQQM, which is the Q's lower cost NASDAQ 100 fund. NASDAQ recently widened access beyond Invesco to firms including State Street and BlackRock. And for some, the final stage is farewell. As popular as leveraged ETFs have become, not all of them survive. Granite Shares has closed 3 of its 2x products. They include MSDD, which was a 2x inverse Michael Saylor strategy, ETRL, which was 2x long eToro, and BULX, which was 2x long Webull. And that is this week's Life Cycle.
Well, another growing feature in the ETF landscape is tokenization, or putting assets on a blockchain. Securitize is one of the biggest companies doing this. It has more than $4 billion in AUM. And joining us for more, I'm thrilled to say, is Giang Boy. She is Vice President and Head of Issuer Growth over at Securitize. And prior to joining Securitize, she served as Head of U.S. Equities and ETPs over at NASDAQ. Giang, great to have you back with us.
Yeah, thank you for having me. It's great to be back.
So let's talk a little bit about what you do, because tokenization, I mean, hopefully all of us, including me, get the basics of it. But you here are, of course, head of issuer growth. Securitize works with a bunch of asset managers, BlackRock probably chief among them here. So tell us a little bit about what your role looks like.
Yeah, so I mean, Securitize, we're a tokenization platform. We're the world's leading tokenization platform. And to your point, we work with issuers to tokenize their funds and their stock. So we work with the world's largest asset managers, including BlackRock, VanEck, BNY, Hamilton Lane, Apollo, to name a few, as well as public companies to tokenize. And what really sets us apart is we really approach it in a regulated and compliant way. So we have regulated entities in the US as well as in Europe to ensure that we're supporting issuers end to end in their tokenization journey. So we support them throughout, from a product design and consultation to tokenization, record keeping on chain, fund servicing, to distribution and secondary trading of the assets.
Okay, so I hear about tokenization a lot. I've dove deep into the topic. There's definitely movement here. You can see all the big names. But then it gets like, oh, are ETFs challenged by tokenization? And I want to get your take on this. Okay, aren't tokens really just distributing ETFs for now? Because you're teaming up with these ETFs. Why are you doing that? To give the on-chain people who have grown up in crypto regular people's assets so they can diversify. Thus, we have a prediction that ETFs will hit 50 trillion by 2035. Now, we originally put 35 trillion, but they're growing at 32% annualized. You can see the chart here.
Oh.
Are we going to be wrong? Like, will tokens challenge this chart because you're going to get the boomers to leave their brokerage account and move on chain? Will that happen, or are we just going to distribute ETFs for now?
Yeah, I mean, when you look at ETFs, it's about revolutionizing the investment vehicle that you're offering these portfolios to investors. Tokenization is the next iteration of that. It's about modernizing the rails that the market is built on. So, tokenization will bring stocks or ETFs on chain and allow ownership to be represented as a digital certificate in a wallet that will be easily transferable in a compliant way, makes it, and there's more efficiencies and more programmatically. And so from a distribution standpoint, to your point, that's really one of the reasons why issuers are tokenizing, is to be able to reach that crypto native investor base. They have a global reach, have a new investor base that might not be buying ETFs there today already. So to your point, I do think it's an accelerant for growth for ETFs. It's going to allow investors globally be able to now easily be able to access their ETFs, be able to transfer it easily, and then also create more utility once an ETF is tokenized. Like when, as an investor today, I can buy, can sell, can hold an ETF. Once it's tokenized, I can also now use it as collateral to borrow against. So I have more options to what to do with my investments in the future.
Okay, good. We can hold off calling the show Token IQ for a number of years.
It's
That's
coming,
good.
Though.
Now, the other thing is, I have this other theory, which is that a lot of these OG Bitcoiner types, their whole portfolio is Bitcoin and crypto. They are moving into, again, the regular people's assets, like stocks and ETFs. And that is part of what has made Bitcoin struggle, is that the price has been kind of flat. It's been like an IPO moment, the ETF. It's like, oh, I've been in it for a long time. I've survived all these drawdowns. Let me cash out a little bit, diversify. I'm a little older. Maybe I have more needs financially. So is this partially why the price of Bitcoin has been struggling, is that a lot of these OGs are actually using your tokens to get regular people's assets as opposed to buying more Bitcoin?
I mean, the adoption of tokenized securities, or they're called RWAs, or real world asset, but maybe we need to rebrand it as real people assets. Either way, some of these acronyms we can think about how to market them. But yes, I mean, people are investing into these tokenized funds because they're a diversification tool away from cryptocurrencies, considering the high volatility in cryptocurrencies, and also, potentially not all of them have intrinsic value. So they're turning to investment vehicles that have been tried and trusted from large brand name asset managers manager like BlackRock, like BNY, like Apollo and Van Eck, so that they know what they're investing in, and they have a much more real portfolio construction when it comes to on-chain investment vehicles.
So Katie had introduced you as formerly head of U.S. equities and exchange-traded products, ETPs, at NASDAQ. I'm curious about how you see the exchanges and their role in tokenizing ETFs and other products as well, because everyone's rushing to get into this.
Yeah, I mean, the exchanges play a very big part in capital formation and ensuring market integrity. And you see announcement across the exchanges about their investment into tokenized securities trading platform or enabling greater adoption for tokenization. So, it's definitely, they see the opportunity in tokenization, and they want to help mature the market infrastructure behind tokenization. So, we actually announced a partnership with the New York Stock Exchange that for their tokenized trading securities trading platform, we will be their first digital asset transfer agent. So that means that ETFs and stocks that we work with issuers to tokenize will be available for trading on the NYC platform, and we'll also be supporting with them in terms of design and also liquidity, considering that we also operate our own trading system for tokenized securities as well. So we're really excited about these institutions playing a bigger role in investing into the infrastructure.
I am curious, what you make of the exchange landscape, because you, of course, left in exchange. We know that when you also take a look at the New York Stock Exchange, when you take a look at SIBO, they've certainly had some high-profile departures over the past several years. I mean, where does that sort of leave the traditional big three? And do you think that, there is room for an upstart issuer, maybe based in Texas, to come in here and sort of upset that triopoly, I guess you would call it?
Yeah, I mean, the ecosystem in ETFs is a very robust ecosystem, really great people, really knowledgeable people. And I think competition in exchanges is good, because that creates more opportunities for issuers to be better serviced, more capabilities from a marketing and support standpoint, liquidity programs that can be done to really foster more ETF adoption, especially with the number of ETFs that are coming to market today. We continue to break records in terms of new ETF come to market. So it's definitely not a zero-sum game. Like, it's definitely opportunities for all exchanges to win, like even new exchanges coming on board. With the volume of listings today, likely you're going to want to be able to have your listings on multiple venues. And so I think it's a rising tide that could lift all boats right now.
Giang, last question for you, and very quickly. Is there anything that can't be tokenized that at this point, you struggle to see how it could be tokenized?
Yeah, I mean, our motto is tokenize the world, so we do live by that. So no, but I mean, I think there's definitely a lot of things that needs to continue to be developed to make tokenization even greater adoption. That part of that is that liquidity infrastructure. You bring on more liquidity providers, you bring on more distribution platforms. That continues to get much more people trusted and more open to adopting to the vehicle.
All right, Giang, thank you so much for joining us today.
Yeah, thank you so much for having me.
Giang Boy of Securitize, formerly with NASDAQ. Now, coming up on ETF IQ, it is time for an IQ test where Joel Weber puts our ETF knowledge to the test. This is a sneak peek of one of the questions. How many ETFs already hold SpaceX? 169, 54, 121, 213. These are very specific numbers.
Yeah, jeez.
You don't want to hear it, but I know this one.
Oh, good. I'm so
Typical. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Katie Greifeld along with Scarlett Fu and Eric Balchunas. It's time for an IQ test where Bloomberg's Joel Weber is going to see whether Scarlett, Eric, and I really know our stuff when it comes to ETFs. You know Joel as the co-host of the Trillions podcast with Eric, also the head of games at Bloomberg, which is just delightful. Joel, what does this week look like?
Welcome back. Last round was a little rough.
Yeah.
Rough, but Eric seems pretty confident already.
I'm so happy for him.
Yeah, let's get into it and see that first question. How many ETFs already hold SpaceX? You're right, very specific numbers. A, 169, B, 54, C, 121, or D, 213. Scarlett?
I'm going to pick 169.
Okay.
I'm going to go 121, though this number will be a lot higher after these index additions.
For sure, Eric?
213, D.
Jeez,
Oh, no.
Oh, with confidence.
yeah.
Let's see. No.
Hold on.
Oh, this is a first.
No. I read James's note this morning. Maybe he included international.
Yeah.
Wow.
I may have to contest this one.
Okay.
All right.
Not the first time that he's attempted to contest it. Okay.
We'll put a pin in that.
Welcome back, Eric. Okay, which fixed income ETF has seen the most inflows so far this year? Is it A, IUSB, B, GOVT, C, SGov, or D, BND? Fixed income.
Boy.
Have you been paying attention, Scarlett?
I'm going to go with BND.
Okay, D,
I'm going to go with C because cash is super hot right now.
cash?
You guys on real yield should
Yeah,
know
we
this,
should.
right?
I know.
Yeah.
We picked different ETFs, so what?
I'm gonna go with Katie. C.
Okay,
SGov.
let's see what it is. All right.
All right.
there we
Okay,
go.
good one.
I needed a win.
It was a little cross-pollination for you.
Wait, so the score right now is 1, 1, and 0?
No, I think.
No.
No, he got that
I got
one.
this one right.
Yeah,
Oh, okay.
yeah.
And the first one. And
We're tied.
And the first one, really.
Okay, it's a tie. Let's see how we end up here. Last question. Kathy Wood's tickers usually start with the letters ARK. One that doesn't is IZRL. What's another? Is it A, QTUM, B, PRNT, C, Moon, or D, Bots?
I know it's not bots.
Gonna go through process of elimination
Yeah.
here.
So I guess PRNT?
Okay.
I'm going to say PRNT as well.
I'm gonna join the club. It is PRNT.
It is PRNT.
Oh my God, you got
We end with a tie. This is great. I'm so thrilled for you all.
really cute.
I was hoping it was going to be a little bit more
Well,
cutthroat.
this one's under review.
Okay,
but
tie,
we'll take it.
and
He's not
he's going to go
conceding
under
yet.
review.
Yeah.
Okay. Well, if you like more of this, we've got more for you at Pointed, at Bloomberg.com/pointed, as well as on the terminal where you can play at QuizGo. And of course, if you like things like leverages, we've got some of that at the Pointed.
Both
version for you.
super fun. It's the reason I get excited for Fridays, not because of the incoming weekend, just because of the Bloomberg quizzes. Joel Weber.
Not the homework for the quiz on Monday? Yeah.
No, I wait all week for those quizzes. That was Joel Weber, and that does it for Bloomberg ETF IQ. I'm Katie Greifeld along with Scarlett Fu and Eric Balchunas, and this is Bloomberg.